Welcome to the Deep Dive. Today we are tearing into the Q2 2025 earnings conference call for AlTi Global, that's ticker ALTI. This is a really interesting one. They operate right at the peak, you could say, a global wealth management and outsourced CIO platform, mainly for the ultra-high net worth community, the UHNWs.
Exactly. And Q2, well, the headlines were, let's say, complicated. You saw this big revenue beat, which looks great, but then boom, a huge GAAP loss right alongside it. But the real story here, I think, isn't just those numbers. It's the context. Q2 felt like the quarter of, well, peak pain. Management was all about execution on this strategy to, quote, strengthen and simplify, basically taking the hit now, spending the money, doing the hard stuff to set up for operating leverage later this year, starting H2.
Okay, right. Let's unpack that because, yeah, the headline numbers did seem to pull in opposite directions. Let's start with revenue. ALTI pulled in between $53.0 and $53.1 million. That's a pretty solid 7% year-over-year growth. And maybe more importantly, it beat the street estimates, which were admittedly limited, but beat them by about $2.5 million. That looks good.
It does. And the quality of that revenue is, frankly, stellar. Nearly 99% recurring management fees. That really speaks to the stickiness of their model, especially with that UHNW client base. Super durable. However, you just can't ignore the bottom line. That's where, all those transitional costs really bit down hard.
And they bit very hard indeed. A reported GAAP net loss around $30 million for the quarter. Depending on how you slice it, that's like a loss per share between what? $1.24 and $1.33. That's a really jarring figure next to $53 million in revenue. It really stands out.
It does. It's a huge number. And this is where we need that operational context, right? Think of it like gutting your kitchen before a big renovation. It's messy, it's expensive, you can't use it for a while, but you have to do it before you install the shiny, efficient new stuff. So while the overall GAAP loss was $30 million, their core engine wealth management and capital solutions that actually generated a pretty healthy $14 million in adjusted EBITDA.
Okay, so that gap, like $26 million or even more, that was almost entirely friction, strategic costs, one-time stuff.
Exactly. Integration costs from deals, some timing mismatches maybe, and importantly, those large one-time professional fees for the transformation work. And, the market sees that big, scary headline loss first, which likely explains why the stock slipped, what was it, about 1.6% into the next day's close. Investors are seeing the revenue, yeah, but they're spooked by the cost structure.
Right. That fear leads perfectly into the main strategic theme for Q2, simplify and focus. And the big lever they pulled for that was implementing zero-based budgeting. ZBB.
ZBB is absolutely central to the whole story going forward.
Yeah.
For anyone not familiar, this isn't just like trimming budgets here and there. It's a really intensive bottom-up process. Every single dollar of spending has to be justified from scratch. From zero, it's painful, frankly, but it's designed to bake in cost discipline, especially across non-compensation expenses for the long term.
And the target from this pretty demanding exercise is significant, right? Management's aiming for something like $20 million in recurring annual gross savings. Non-comp expenses. And they expect that to start hitting the bottom line in the second half of this year, 2H 2025.
That's the plan, yeah. And that's precisely why Q2 looks so expensive on the cost side. You have to spend money now to achieve those future savings. Operating expenses just ballooned, $83 million for the quarter, way up year over year. And importantly, that number included about $7 million in just one-time professional fees, consultants, advisors, whatever, specifically for the ZBB project and those transformation initiatives. So they paid $7 million to figure out how to save $20 million a year.
Okay, that makes accounting sense. You invest to save later. But it definitely introduces execution risk, especially in the UHNW space, right? ZBB can sometimes be seen as, well, ruthless. It can sometimes hit morale or even talent if not done carefully. And UHNW clients are paying for top-tier relationships, deep expertise. How does management balance aggressive cost cuts with keeping the talent that attracts those clients?
That's the million-dollar question, isn't it? Or maybe the $20 million question here. Management's line on this was pretty clear. The ZBB savings are focused primarily on non-compensation expenses. Think systems, tech overlaps, vendor contracts, maybe some organizational layers, but not, they claim, the frontline advisor talent. The argument is they're cutting operational fat, streamlining the back office, not reducing the quality of client advice. But you're right, the proof will be in the pudding. The market's definitely watching to see if service quality holds up under this pressure.
Okay, so beyond ZBB, the other big simplification move was getting out of the international real estate business. That seems like a cleaner win.
Oh, absolutely critical, yeah, for cleaning up the profit and loss story. Management really framed this as a deliberate pivot back to the core, back to that UHNW recurring revenue model. And they pointed out, look, this international real estate unit, it was losing about $2 million on an adjusted EBITDA basis every single quarter. So just getting rid of that drag is an immediate $2 million quarterly boost to the run rate EBITDA. That's before any ZBB savings even kick in.
So it's not just stopping a loss maker, it's also shedding complexity, avoiding distraction, maybe regulatory headaches that don't fit the main OCIO model.
Precisely. Less complexity, less volatility, gets them focused. Management was pretty blunt, saying the reported Q2 numbers actually understate the real earnings power embedded in the business now. Because Q2 had all the peak costs, it still had that real estate drag, but it didn't yet have any of the benefits from the cleanup.
Okay, so Q2 was the paying quarter. Got it. But while they were trimming costs, they were also adding scale, right? The growth side.
Yeah.
The big headline there was closing the Kontora acquisition.
Kontora was massive for scale, yeah. Added roughly $16 billion in billable assets under administration, AUA. That really beefs up their European presence, especially getting them deep into Germany, which is a key UHNW market. And it's worth remembering, Q2 results only had 2 months of Kontora's contribution baked in. So the full impact hasn't even shown up yet financially.
Okay, speaking of execution risk again.
Yeah.
How do you run a really tough ZBB cost-cutting program while also trying to integrate a huge new platform like Kontora? That sounds like, well, a recipe for potential internal chaos, doesn't it?
That certainly raises eyebrows, yeah. It's ambitious. But management's clearly betting the farm that the synergies and scale benefits from Kontora will vastly outweigh any short-term internal friction. They seem to think they can integrate the systems and back office while ZBB tackles the broader organizational stuff, parallel tracks. And honestly, their organic growth pipeline suggests they have some confidence things are working internally despite the churn.
That's interesting. So even with all this transformation noise, the core organic growth engine was still humming.
Seems like it. The pipeline numbers they shared were actually quite strong. Internationally, first half of the year, they signed up new clients worth over $500 million in projected billable assets. And in the U.S., new and expanded OCIO mandates, nearly $430 million through June. Management actually said the current pipeline is one of the largest in their history, including some really attractive large OCIO deals.
And they seem to be focusing that growth effort geographically, too. They mentioned the Middle East specifically.
They did, yeah. Cited it as one of the fastest growing wealth markets globally right now. And the key angle there, they said, is a growing preference among UHNW families for independent, conflict-free advice, which, fits ALTI's model perfectly. That's their whole pitch. Plus, they add a little detail in the Q&A, kind of important. Internationally, the return on assets, the ROA on the new business coming in, it's actually higher than the ROA on assets leaving. So net-net, they seem to be improving the overall profitability mix of their AUM.
Okay, this brings us neatly to the so what for investors, right? Q2 was peak pain, peak cost. The story now is all about the pivot in the second half of 2025.
That's exactly it. The guidance, while qualitative, points firmly in that direction. They expect H2 results to progressively reflect this leaner, core recurring revenue model, finally showing some operating leverage. The ZBB savings should start flowing through. That $2 million quarterly real estate loss is gone. The company is really trying to shed its old image as this sort of diversified, maybe slightly unwieldy platform, and recast itself as a much more focused, efficient UHNW wealth and OCIO machine.
But hang on, if the story sounds that compelling, clean recurring revenue, $20 million savings on the way, big acquisition integrated, why did the stock only dip 1.6%? Why didn't it pop on the revenue beat? It feels like the market hears the story but isn't quite ready to pay up for it yet.
Because it boils down to credibility. It's show me story now. That little dip signals nervousness about execution. Can they really integrate $16 billion in new AUA smoothly while implementing deep cost cuts? Investors need to see the proof in the numbers. They need to see that operating expense line actually come down consistently. They need to see tangible margin expansion in Q3 and Q4 before they'll give ALTI a higher valuation multiple.
So we need to track the catalysts. What are the specific things we or you, the listener, should be watching for to see if management delivers?
I'd say 3 main things. First, hard evidence of those $20 million annualized savings actually hitting the bottom line. Lower non-comp expenses quarter over quarter. Second, a really clean P&L in Q3. No more real estate noise, no more big one-time transformation fees clouding the picture. And third, signs of successful integration and maybe even cross-selling from Kontora, turning that huge chunk of AUA into higher margin revenue. If they hit those marks, that valuation gap compared to their peers could close pretty quickly. And don't forget, the foundation is still strong. 96% client retention is huge. And they have a debt-free balance sheet with $42 million in cash.
Yeah.
That gives them breathing room.
Okay, that detailed analysis sets us up perfectly for our final segment. Time to explore an aggressive, maybe even outrageous trade idea based on this. And of course, the mandatory disclaimer comes first.
Absolutely. Let me be crystal clear. This is purely a thought experiment. It's designed to illustrate potential upside if management executes perfectly on their plan. We are absolutely not investment advisors. This is not financial advice. Investing carries significant risk. Always do your own research.
Right. So consider this an aggressive internal pitch meeting scenario. We're assuming management nails the execution, cost peaked in Q2, no major integration stumbles. What's the pitch?
Okay, the outrageous but plausible pitch is go levered long ALTI right now. The bet is simple. Assume that entire $30 million GAAP loss in Q2 was just the necessary price tag for getting lean and focused. It requires deliberately ignoring near-term integration risks and betting purely solely on rapid margin conversion driven by cost cuts.
Okay, let's game out the math on that pure run rate potential.
All right, start with the current consolidated adjusted EBITDA, which was $4 million in Q2. Now, first step, immediately add back the $2 million quarterly drag from the exited real estate business. Gone. That gets you to $6 million right there. Then, let's be slightly conservative, assume they only realize half of their promised annual ZBD savings initially. So $10 million gross annually, that's $2.5 million per quarter in EBITDA improvement.
Wow, okay, so take the $4 million base, add the $2 million from the real estate exit, add another $2.5 million from just half the initial ZBB savings. That immediately boosts the quarterly adjusted EBITDA run rate to $8.5 million. That's well over double the Q2 figure, just from internal execution playing out. 112% jump.
Exactly. And that kind of rapid margin expansion, if it materializes, makes the current stock price look potentially very cheap compared to peers who already operate with that kind of leverage. If they hit even, say, 2/3 of their internal margin goals over the next, 9 months, the re-rating potential is substantial. The aggressive thesis is basically that Q2 was the absolute last chance to buy this stock at a discount before the cost savings become undeniable in the P&L.
That is definitely a compelling bull case, heavily focused on operational discipline delivering. So to wrap up our deep dive, AlTi Global's Q2 was the inflection point. Transformation costs peaked. All eyes are now in the second half of 2025 for margin conversion.
Precisely. And that leads us to the final provocative thought we want to leave you with. Management has shown they can make the tough calls to cut costs. They're potentially building up significant free cash flow generation power. The big question now is, what do they do with that extra cash flow? Well, they plow it back aggressively into organic growth, fueling that big U.S. and international pipeline, investing in tech. Or will they use the enhanced margins and cash to maybe further stabilize things, pay down any minor debts, or perhaps even fuel more selective platform-enhancing M&A down the road? How they choose to allocate that newfound resource will likely define ALTI's trajectory and stock performance over the next year or so.
A fantastic question to ponder as you track ALTI's progress. Thanks for joining us for the deep dive.
Until next time.